to cover what I usually do in about 40 minutes, which is a little ad for Optima, who we are and what we do. And I just want to start off by saying this. You know, we are a life insurance IMO, and I'll tell you this, there's not many people that do it better than we do or know more than we do. I like to say this. The IMOs that you're working with, you generally go to a company with someone at the top that really knows what they're doing. But our company, every person that you deal with sells life insurance, has been in the field, longevity. All of us have been doing it for at least 10 years and know what we're doing. I don't want to go off on that tangent too much, but I'll say this. We do it the old-fashioned way. We are training people how to sell life insurance. All the IMOs out there are telling you they're wonderful at IUL. They're great at whole life. They understand all this stuff. And what I think we do is we train the agents on how to sell life insurance. And what do I mean by that? You know, people don't really understand all the different types of life insurance. I think one of the best places to go look for some business is literally in your database, because you may have someone that has an old whole life policy or an older term policy or an old GUL. And agents and clients and even wholesalers, representatives from insurance companies don't know how all these products work. And I just want to give you a couple quick examples, and then I'll turn it over to Drew. But you know, when I think about term insurance and what happened in the year 2000, you know, in the year 2000 was really when the internet started going and companies started selling a lot of term insurance. And what did they do? They didn't want to lower their prices or raise their prices or play with things because the law changed for reserve requirements. And technically, they had to raise their fees. But what they do, they changed conversion privileges. And I just want everyone to know that if you're selling a Genworth, you're selling a Banner, you're selling an ING, you're selling AIG, yes, they're convertible, but convertible to what? There's a heck of a story that's being told. Then there's the truth. And I want you guys to just know this. Your clients need to decide when their insurance is going to end, not the company. So there's a whole story there we need to understand. You know, Penn State did an awesome study years ago talking about term insurance, and there's some phenomenal statistics that you all need to have access to. So at the end of this call, Greg's going to tell you about a school that we do where all of this training comes to, and you can learn more about term insurance than you ever thought possible. You know, I mentioned GUL. Most agents don't understand how shadow accounts work. Nationwide did a study with 3,100 policies and found that 49% of them, 49%, were not guaranteed anymore because of the timeliness of the payments. And what I find interesting about that is a third of them were because people paid too early. And when you're an actuary, if you look at an early premium, it's not really 2 weeks early. You know, it's 50 weeks late, and that's how these products are priced. I want you guys to understand how that works. And then there's whole life. A lot of agents will talk to a client with a whole life, and you know, we all know there's a big, big line between whole life and universal life, guys. Not many people sell both. But I just want people to understand how whole life works. And you need to be able to look at a policy, look at an annual statement, and decide if it's properly funded for cash accumulation or if it's properly funded for a death benefit sale. Two completely different things. What are paid-up additions riders? What's the term rider? What's the base policy? How do they work? I want everyone out there to understand that. And you know, I do about a 45-minute presentation just on dividends and whole life in the school that we're going to talk about at the end. And then a little bit about variable life. And not many people out there still sell variable life. It's not the fastest growing policy anymore. Index universal life is. But when someone has a VUL, they need to understand what happens when the net amount at risk increases because the cost of insurance is going up, because all of the separate accounts, the mutual funds within the policies, are going down. And just in a nutshell, I'll say this. As the market drops in a VUL, you have to buy more insurance, and you have to sell your net asset values at a smaller number to cover a higher amount of insurance. Kind of confusing without a slide, but we do a lot of talking about those different policies and just teach you how to analyze them. And then, of course, there's index life. And I've been doing index life for a long time, and I'll say this. Patrick Kelly and Rocky DeFrancesco have both said that I know more about index life than most people in the business. I consider myself an expert on it, and I'd love to chat with people about it. But this is not a show to do that right now. I really want to focus on why we're all on the call, and it's this relationship between Optima and Horter. And to have an RIA is essential in your practice nowadays. And to me, when I look at what's happened to the annuity business out there and the whole source of funds issue, it's a very interesting world that we're all living in. We've all seen what's happened to the applications, to all of the complexities with compliance that have happened in that world. And I'm seeing the same thing on the life insurance side. So if you're in the life insurance business, you really need to take a look at an RIA because there's already a few states that have challenged the source of funds. with certain policies and certain monies coming from mutual funds or coming from a variable life policy, you'll need a securities license, or you'll need a, to have other securities license to make it so you can do those transactions. And also, I want to say this. If you're in there selling life insurance and someone else is taking their assets under management, you're missing the boat. You may have a customer because you sold them a term policy and then you sold a permanent policy to the spouse and did something for the kids, but you truly get a client and you get much better control of what's going on in the house when you have these types of licenses, and you can be a full service rep, full service agent, a full service advisor to your clients. And I think that's all I'll say, because Drew's going to cover a lot of it. So with that, Drew, why don't you go ahead and tell them a little bit about Horter and about the relationship between Optima and Horter.
Thanks, John. I appreciate it. I appreciate the opportunity to talk to your agents about what we do, how we do it, what we've done with advisors in the past since we started bringing on advisors about 7 years ago. My background is pretty varied. I've been in this industry since 1982. I've had a 6, a 7, a 22, a 24, and a 63. I gave those up about 6 years ago to focus only on the RIA side. 1986, I got my CFP. 1991, I formed my own RIA. Actually started a fee-based business in 1988 after the 1987 crash. So I've seen a lot in the last 32 years, and our focus is helping advisors or agents out there build a full practice to be able to garner on the asset side 10, 20, 30, 40, and now even $50 million this year with a couple of our advisors. So it's key to with my background as a practitioner for 25 years mostly of my 32-year career, that I can show you how the success can happen. I can show you the process. I can show you the numbers. I can show you start to finish how you can have an incredible practice, maximizing life sales, maximizing the assets you get from a client, getting total control, and having a foreseeable, predictable business model. So enough with my background. We'll get on to a little bit more. We do manage about $1.1 billion, and we have about 300 advisors now. So our goal is to, again, help you become as proficient as you can be in this industry in a process that works. When we do our monthly training, I tell people that if you come to our training or you go on to our online training once you're with us, and you seriously take it and study it and ask questions and work with our vice presidents of sales, in 6 months you'll know more than 95% of the advisors in the country. And I don't say that lightly. I've had guys that are doing it that didn't have a 6 or a 7 before and haven't ever been in the securities industry because they're afraid of the industry. We're going to teach you how to not be afraid of the industry and destroy any competition you run into. So first of all, our platform doesn't do you any good unless you're in front of prospects. So if you want to get in front of 5, 10, 15, 20 new prospects a month, we have the marketing tools to do that. They've been proven in Big Town USA, Midtown USA, Small Town USA. We do it all the time, and we can relay those 4 or 5 main external marketing programs and relay to you what we do from an internal marketing standpoint, so you can grow your business as much as you want based on those parameters. What I really like is the feedback we get from our advisors when they're taking money away from a Morgan Stanley or an Ameriprise or an Edward Jones or Raymond James. It doesn't make any difference. They're all doing the total opposite of what we're doing, and that's buy and hold and asset allocation. We do tactical asset management where we can go risk off, protect the client's principal, and then go back in and make money when the opportunity affords itself. So it doesn't make any difference who you run into. In fact, you can't wait to run into a Merrill Lynch or a Morgan Stanley or a large regional bank, because they're doing everything wrong according to most of the risk tolerance of the people you're going to be running into. We get all the clients' assets 80% of the time. The only time we don't get all the assets is generally higher net worth people, and I'm talking about over $1.5 million won't give you all the assets. So when I was running my practice successfully, and this is what we're basically doing here is replicating my practice, when I was doing $25 million a year back in the early 2000s. The larger the portfolio is, the less likely you're going to get all of it. So the sweet spot that we have for our advisors are $200,000 of investments to $1.5 million and a 45 to 60-day sales cycle. So you can turn your inventory of clients and bring on 8, 9, or 10 new clients a month if you want, following our standards and procedures. In addition to maximizing the life sales, with most of our advisors that do anything on the annuity side, we've been able to at least double and sometimes quadruple the amount of annuity sales they do because you're getting all the assets now. You're not selling a product necessarily, but you're actually out there selling a money management system of safety and security, low risk and low volatility, and some moderate risk. So it's a system of managing money so you don't go backwards over time. I don't like risk, and I don't like going backwards. So after living through buy and hold and tactical asset management through most of my career in 2007, I changed to I want as high a rate of return as I can get, but I don't want to go backwards over time. And that's a pretty tall order when you're looking at money management, when people lost 51% from October of 07 to March of 09, and then came back and only made 26% in the latter part of 09. So if you're dealing with retirees or pre-retirees, going backwards is a death knell to their financial future. So we want to prevent that as much as possible. We have about 33 employees here, 5 or 6 in compliance, probably 15 or so in new business, a trading department, 5 vice presidents of sales to help you with caseload, to understand brokerage statements and tax returns. So operationally, we're set to help you grow as much as you want, between 7, 8, 9, 10, maybe even more new clients per month. Now, John mentioned the regulatory issues. I will tell you, the only time a lot of our advisors look to maybe get in trouble is if they don't, before they join us, they're the total at-risk position that if they're talking about moving any types of assets from mutual funds or variable annuities or wherever stock accounts, you've already violated the law, and the state securities commissioners are very sensitive to this and getting more sensitive. So if 151A was dead a few years ago by the federal government, now the states are actually taking this even more seriously. So not only to enhance your practice by becoming possibly an investment advisor representative with Horter, but now you don't have to worry about violating securities law and have your license taken away because you'll have a Series 65. While I'm on this subject, anybody that has a 65 is a CFP or is a CHFC or has a 7 and a 66, you're all exempt from taking the 65, CFP, CHFC, and 7 and a 66. So usually when I announce that on a webinar or a training, I have 1 or 2 people jump out of their seat, and happiness because they don't have to take the 65. So, but it's a very, very big concern, and you need to pay attention to that. And now with our training, if you pay attention to it and you do it, you can go from 0 to $40 million to $50 million of assets. We've got guys doing it. Our elite advisor group all average about $45 million a year, and they've only been with us for about 4 years on average. What is the Series 65? The Series 65 allows you to charge a fee. You become a fiduciary, which means one thing. You have to do what's in the best interest of the client. Very radical concept. Yet on the opposite side, on the Series 7 side, you meet a suitability standard. And the suitability standard means I can sell you anything I want as long as you have the income, the assets, and the risk tolerance. Well, I don't want to sell garbage to anybody, but that side of the industry sells a lot of garbage in my opinion, and that's why 6 years ago I gave up my FINRA licenses, because there was nothing on that side of the equation I found attractive for my clients. So what does it take? You have to pass the Series 65. At the end of today's webinar, we're going to actually put in our email addresses and a telephone number that if you want to get our introductory email to Horter and how we do, how do you become an IAR, you can look at our manager performance. You can see our training schedule and have a lot of other information in this introductory email above and beyond what I'm going through today to teach you how the different things that we do, and you can get on our drip email list and learn more and more and more. So what's it take? Series 65. Series 65 is an exam. It's not an easy exam, but with our different classes we offer with some third parties, about 70% of our advisors pass on the first test. I love telling the stories about when guys started to increase their average sale per client. When I was running my practice, I did about 30 dinner workshops a year. I got 1.5 new clients per workshop, so that's 45. I got about 5 referrals. The key was I got about $530,000 per average client, which puts me at my benchmark. I wanted to be doing between $25 and $30 million a year of new assets every year like clockwork, and we can teach you that. So when you go from an average sale now of maybe $100,000 in a FIA and a life case, now you can go to $175,000 or $400,000. In some cases, we have guys averaging $600,000 or $700,000, per new assets per client. Now we have something in training. We do training every month in Cincinnati. We do our national convention is in Las Vegas in September, which you would all be invited to. It's very much a system. And if you ever watch, there's a show called The Prophet, and that's why everybody ever watches that. But The Prophet, he's got it right. It's people, process, and product. You got to have the right product, you got to have the right people, and you got to have the right process. So our financial manufacturing firm is the process. Follow the process, work with our vice president of sales, work with our new business people, work with me. If you follow the process dutifully, you will be very successful. If you deviate and don't pay attention to the process, you will not be successful. It's quite simple. So we start with marketing. We teach you how to do the first meeting. We teach you how to do the second meeting, paperwork for the third meeting, and then our new business team helps you get assets over, and then how to do your financial reviews with the client. So we love to complement the low-risk, safe, and secure advisor. This was all designed around how could I find the lowest amount of risk possible to complement the FIA sale. I wanted it to be an easy segue from the FIA sale to low risk and low volatility and a higher probability of long-term investment success. Volatility to the downside is your enemy. I tell the story in the training all the time of the 65-year-old client, a male and a female, obviously married. One of them will probably live to age 90. And let's just say they have a pool of money of about $1 million. And they're happy, and they're going to travel, and they're going to see their grandkids, and they're going to take out 4% a year or $40,000 to supplement their Social Security. And then all of a sudden, they're in the typical 60-40 portfolio with your brokerage firms. And don't get me wrong, I love the brokerage firms. I love taking money from them every day. So this 60-40 portfolio, which in October of 2007 to March of 2009, lost 35%. So let's just round it off and say next time we have a calamity, which we're not probably that far away from, and now the portfolio is worth $600,000. But they're taking $40,000 still based on $1 million. Now they're up to a 7% or so distribution rate, which will not last their lifetime. Plus they're trying to evade inflation. So retirees and pre-retirees, if they stay with the buy and hold mentality, stay with tactical asset management, and the 25 years that they're going to live in retirement, they're going to be financially destitute, in my opinion. So how do you get successful? You got to train. You got to learn what we do. You got to learn how to be successful. You got to learn how to get in front of people. You have to learn how to say the right things at the right time. You have to, know how to professionally destroy the competition. We call it undressing the emperor. So when you undress the emperor, you're exposing all the ills of the brokerage community and the banks. You're merely showing them with third-party information. If you want to stay with your high risk, high volatility, and no probability of long-term investment success portfolio, or you can move to our safe and secure, low risk and low volatility and a high probability of long-term investment success. It's up to you, and they can make the choice. They can stay with high risk and high volatility or move to a portfolio even combined with 30 or 40% in the FIA. You should be able to earn 5 to 7% per year over the next 5, 10, or 15 years and not go backwards. The only time I ever use the word guarantee is when I tell a client, I guarantee I'm not going to make you rich. But I have a very high probability that for those next 20, 25 years, you're going to be fine and be able to take out 3 or 4% per year in income and be able to evade inflation and actually sleep at night. So we look at the financial manufacturing firm and what we do. We learn how to complement the FIA. We are low risk and low volatility. We want a high probability of long-term investment success. It is what becomes of your practice is you have more fun than you've ever had before because you can't wait to see what brokerage statement they're going to hand you and who you're going to destroy in the next meeting. Doubling your FIA production, that seems to be fairly easy. We've had guys go from $7 million about 3 years ago, and this guy's going to do about $22 million in FIA sales, and he just started with us in 2011. What's cool about this is that what I really love about it is with our system, if you want to do $5 million a year of assets under management, in 5 years, roughly, you're going to have $25 million. With our payout schedule, you're going to be between $250,000 and $300,000 of recurring revenue. That's basically a pension as long as you maintain the clients. I live in Cincinnati and work in Cincinnati, and I have lots of GE clients, General Electric, and those guys work 45 to 50 years just to get a $50,000 a year pension. Plus, whenever you have that $250,000 of recurring revenue, there's now a value to that practice of roughly 2.5 to 3 times that. So right now, in 5 years, if you do a 5-year business plan, you can have upwards of a $600,000 or $700,000 value to your practice while you're receiving, $60,000, $70,000, $80,000 a quarter. So we teach you how to look at our portfolio analysis and use those with clients. And again, we're trying to protect your client assets from disaster, which happen about every 6 or 7 years. It seems like in the United States, we have these calamities, bubbles, recessions, call them what you like, but it's part of the capitalist economy. We have greed and fear, so we're going to continue to have them. I don't know what's going to be the tipping point in the next one, but it'll happen because we always get too egregious in good times and too fearful in bad times. So this is our managing risk 3 buckets. This is a very simple first-grade mentality of how to do somebody's risk tolerance. The first part in the blue area is kind of my tease. I'll tell a client before I talk to them, look, when you become a client, always using the assumptive sale, I'll say, look, when you become a client, we will offer you long-term nursing care information. We'll offer you income tax preparation or estate planning, or even Social Security consultations with our outside firm. But we'll get to that once you become a client. Setting up that we're not only going to manage your money and do life sales and long-term care, but we can provide all these other services. So after about 10 minutes of the first meeting, I'm going to talk to the client and say, look, when I analyze your portfolio, before I could even do that, I really need to understand how you view risk. So in this first green area, I'm going to ask the question, if you could earn 3, 4, maybe 5% per year over the next 5, 10, or 15 years and not go backwards, what percentage of your assets would you put there? And most people will say between 30 and 40%, because they're not going to lose and they're not going to go backwards. Now the next bucket is not risk-free. It has low risk, low volatility, but if you could earn 6, 7, maybe 8% a year over the next 5, 10, or 15 years and not go backwards, what percentage of your assets would you want to put there? And let's just say they say 20%. So you're saying 40% where you can't lose, 40% low risk. you're okay with a little bit more volatility with 20%. And sometimes they'll say yes, or sometimes they'll say no. Either I'll increase that to 30%, or I'll subtract 10% and put it in that lower risk bucket. So now I have their risk tolerance test, because now when I review their portfolio, it's usually diametrically opposed to what they just told me. It's usually 60% in the moderate risk and 40% in the low risk, which is, it's actually a lot more risk than our low risk, and virtually nothing that's safe and secure. That's basically cash for them. But most of the time, that's what you're going to run into. So what do you really want? Do you want high risk in your stocks and moderate to low risk in your bonds, or do you want safety and security, low risk, and moderate risk with a high probability of long-term investment success? In addition, there is a line down below. What is the maximum loss you would accept before you would begin to feel very uncomfortable? And some will say 10%, some will say 15%, but you want to put that down, because most of them, once you show them with some of our third-party information that your current portfolio lost 35% from October of 07 to March of 09, they kind of freak out. They don't know that they lost that much money, because they understand, okay, diversification, that's the best thing you can do. No, diversification is good, but you can't have risk to the downside. That's why tactical asset management makes sense. Now, I do have them sign this at the beginning of the second meeting to confirm that this is what they want as their asset repositioning. When we take their current $1 million portfolio, we're going to divide it 400,000, 400,000, and 200,000. So I want confirmation, and this is the first part of the sales process of having them sign something. So, I mentioned before, I did 30 workshops a year. I was doing over $25 million a year. Hello? So when I would do $25 to $30 million a year, other advisors started asking me, hey, can I follow your system? The first I said no. I said, it took me 25 years to figure it out. Why am I going to tell you? And the guy would say, okay, well, I live in Philadelphia, or I live in Florida, or I live in Texas. And eventually I acquiesced, and from 2007 to now we have about 310 advisors. So the system works. People are doing great. We have lots of testimonials that we can put on our advisor site only, which is HorterTrustedAdvisors.com. You'll see that in a second here. Go there to the advisor services side, listen to what some of our elite advisors talk about Horter and their success, and you can go to and read some of the comments by some of our other advisors, how we've changed their lives. So we also teach, and this is the fun part, when you work with us, we teach you how to be part financial detective. You know, I'm sure a lot of you guys watch that old show, Columbo. Well, we really like to show people how to do that. How do you build wedges, you know, reading a brokerage statement? Oh, Mr. and Mrs. Jones, I see you have $60,000 worth of unrealized losses in your mutual fund portfolio. I'm sorry to hear that, but we'll talk about that more next week when I analyze your portfolio. Or you see that on the tax return, oh, I see you have $3,000 on your Schedule D, line 13, and you've got another $300,000 that your broker created for you in 2008. We'll show you a better way to use that now asset, but I'm sorry that you lost that $300,000. So the brokerage statement, we're going to take the top 7 to 10 holdings, show you how to do an analysis of what the fund is all about. What type of fees, what type of commissions, what type of 12B1 fees, if it's a 2-star, 3-star, 4-star, and then we're going to do an interactive chart that shows you top to bottom loss and from October of 07 to March of 09, where most mutual funds, stock mutual funds lost between 45, 50, 55, 60, and some as much as 70% of their value. And Mr. and Mrs. Jones, is this something you want to keep, with the probability that this could happen again and destroy your financial future, or would you like to go with safety and security and the higher probability of long-term investment success? We have some proprietary software that we use. It shows you how to use, in this instance, a blended portfolio of our low risk and moderate risk investments and compare them directly to, in this instance, American Funds Income Fund, American Funds Balanced, and then your normal 60% stocks to bonds. This way we can show our managers versus their actual top 7 to 10 holdings to show them the good and the bad and the ugly of what they currently own. And then the key question here is, which color line do you like best? We also show them a lot of the terminology we use will evolve around max drawdown. What's the maximum drawdown or loss of assets and loss of value that these portfolios have had that they currently own over the last, say, 10 or 15 years. In this instance, the black line is the 60-40 stock to bond, which lost about 30% in 2008 and 9. American Funds Income, which is the yellow line, lost about 37%. The American Funds Balanced lost about 33%. And you see the blue line, our balanced portfolio, the worst drawdown looks like it was maybe 4%. So max drawdown is a key word you'll learn in our training to expose while we undress the upper, how much risk to the downside they have in these mutual funds or common stocks or ETFs that they own. And then numerically, we'll also show it that our blended portfolio for the last 10 years, net of fees, averaged 14%. Their income fund averaged 7%. Their balance fund averaged 7%. And the 60 to 40% stock to bond portfolio was up 6.67%. We like to show this because some people see things well pictorially. Some people see things better numerically. So this gives you an instance of some of our proprietary software that we've been able to put together and help you in the sales process get all the assets. The tax return. Most people don't, or I would say most, about half the people actually collect the tax return. You got to collect the tax return. It is the window to their financial soul. You'll learn more from the dividend line, the interest line, anything in the capital loss carry forward line, their Social Security, how much being taxed, what their effective tax bracket is, and what their marginal tax bracket is. You know, Schedule B will tell you everything they own, where all their dividends are being paid from, and where all their interest is being paid from. It's your checklist when you're trying to make sure you know everything about that client and what they have investment-wise. They can't hide it. Well, I guess they could if they're lying to the IRS, which is generally not a good thing. But we teach you how to use this as a tool to, again, show how much smarter you are than the competition. The beauty of our system is it has a unique selling proposition to the public. They're not going to hear what we talk about. You know, the key is that they're used to buy and hold and asset allocation. If you're trying to compete on that basis, it's like, okay, guess what? You have to like me better or really hate your current advisor to come with me because I'm selling you the same crap. Excuse my French. With our system, it's safe and secure. It's tactical asset management, and we go risk off to protect their principal when bad things start to happen. Totally different ball game. So they want to hear your message because you're not, you know, saying the same stuff that's being sold by other people. We do have a minimums, or at least for our low risk side. When we started out in 2007, our minimum standard for a manager to be hired had to average at least 7% per year, and not lost money in the bad stock market years, had to have been flat or made money. So as a general criteria, we want low volatility to the downside with our low risk managers and a minimum standard of 7% per year. Here's an example of one of our managers since 1992, working on 23 years of history. You can see the average 8.86. You'll also notice net of fees and expenses in the full year column. They've never had a down year. But as you can see to the left, there's plenty of red in there, and they have had plenty of down quarters. So it's not that they can't lose money, so don't get me wrong. I'm not saying that. I'm saying it has lower risk and lower volatility. I will bring your attention to 2008, where they managed to make 7% net of fees and expenses and came back and made 45% in 09. So protect me, make me decent money in bad times, but and give me the opportunity to make good money in good times. Here's another manager. This is more on the moderate risk side, but you can see that they made money in 2000, they made money in 2001, and they lost a little bit, 7% in 2002. If you remember those 3 years, 2000 was the tech bust, the dot-com bust. 9/11 happened in 2001, and then we had a recession in 2002. So not a good period of time economically or for investors, yet there was a net positive gain of 10% for this manager, where the S&P 500 lost over 40% those 3 years. If you scale down to 2008, they did lose 1.26% net of fees and expenses in 08. Again, this isn't a stock portfolio, so they do go risk off, and came back and made 38% in 2009. This year through September, they're up about 10%, probably holding pretty steady to that right now. Just to let you know, moving up to the #1 spot in 2013 is the fastest growing RIA in the country. That's due to people following our process and utilizing our mix of assets. So we're very proud of that, going up to roughly $700 million at the end of last year, and we'll close out at about $1.1 billion this year. So we want to really help the Optima advisors not only maximize their life sales, maximize their annuity sales, and maximize whatever they can garner under assets under management under our RIA firm, Registered Investment Advisor firm, under the auspices of the Securities and Exchange Commission. So we're very proud to be in #1 and growing as fast as we have. And it's really our training and helping those guys implement it and changing their lives for them, their families, and their clients. On the next one. So what's next? Well, it's up to you. We're going to show you, some of our key information where you can contact us. But, as John mentioned before, you're really taking a risk by not being securities licensed. But if you're going to be securities licensed, you may want to become the whole practitioner and get all the assets most of the time, maximize all life sales, and then take, while you're in front of those clients and not bringing in the other assets sitting on the table, you'll have a full arsenal of ability to do that. So our lines will be open to you to tell you more about what we do. As I mentioned before, if you get our introductory email, it'll have our training schedule. You can come to one of our trainings, no cost. You got to get to Cincinnati. You got to pay your own way and pay for your hotel, but we give you 14 hours of free training. We feed you lunch and take you out to a great dinner on Thursday night. You get to meet some of our other successful advisors. So if there's ever 2 days you've invested and you really want to see if this is the right fit for you, you'll get that training schedule, and you can work with my assistant Patty if you want to register for that, or talk to Jack or myself or Lee or Tim or Joe, our other vice presidents of sales that are here to help people understand our process and our systems. So here's my contact information. Here's Jack Peters. He's our Senior Vice President of Sales. If you want to contact us, you can call us by phone. You can send us emails, additional questions. We're an open book. We're transparent. We know we may not be a fit for everybody, but we know that if you're a fit for if you are somebody that's looking to truly accelerate your practice and really be, make a lot more money and do it the right way and protect your client assets, then we're a firm you want to check out. So Greg and John, that's about it for me. I don't know if we have any questions in the chat area, but that kind of summarizes my talk, and I hope I didn't go too fast, or I think I tried to cover as much territory as I could and make some sense to you all.
Yeah, absolutely, Drew. I appreciate that. As of right now, there's no questions on there. If anyone wants to go ahead and ask a question, please do so. Just one thing, too. I've been getting a couple emails from some of you on the call as we've been going through it. And, yes, this call was recorded, so we'll get you guys a link if there's anything that you want to go out and review. Just to add one thing with our relationship with Horter, and I mentioned this to Drew when Drew and I had a call last week. I've heard from a lot of guys in this space that one thing that Horter does probably better than anybody else in this industry is exactly what Drew was talking about, getting guys up and running on a system and hands down some of the best training that you can receive in this space. So I just wanted to kind of reiterate that. One other thing, too, that I would like to, before some questions are coming in, as John mentioned at the top of the call, a lot of you probably get Rocky D. Francesco's newsletters. We are actually going to be doing a life insurance academy, a 2-day school in February 23rd and 24th in Orlando, Florida. Rocky will be in attendance at that, speaking along with John and myself. If you're interested in that training, please reach out to me or John or anybody at Partners, or again, if you've if you get Rocky's newsletters, all the information is on there as well. So, Drew, let me look here. I think we have a couple questions. I'm just going to kind of go down the list here, and I'll let you. First question says, who clears the trades?
Yeah, our custodian is Trust Company of America, and we're soon to sign an agreement with TD. They will custody all the assets and do all the trades.
Perfect. Next follow-up question is, who is the IRA custodian?
Same answer, TCA and now TD.
Okay. Okay, let's see. If you already have a Series 6, are you exempt from needing a 65, which you did answer that?
The 6 is not exempt. It's only the 7 and the 66. So you would have to take the Series 65. Unless you're in Ohio. Unless you're in Ohio, which we are, if you've ever had a Series 6 or ever had a Series 7, you're exempt from taking the Series 65. Only state that does that.
Okay. Two questions here. So, what advisory fees are charged? And then another one, a couple people asked within that same one, what is the split with the IAR?
Yeah, we actually have a high fee, but our average fee is around 2.4%. But it goes higher than that on smaller accounts and smaller portfolios. It's up to the advisor. We have a very graduated payout system, anywhere from 75 basis points to where somebody starts. Once they get to $4 million of assets under management, they go to 1%, and that now is on all assets. When they get to $10 million of assets under management, they get a 10% increase. At $20 million, they get another 10% increase. And at $40 million, they get another 10% increase. So you could upwards, if you didn't discount at all, earn up to 1.3% on the portfolios that we utilize.
Excellent. Let's see here. One question actually for John and myself. It asks about attending the IUL training in Orlando if you have to move a contract. One of the things that we've kind of built this firm on is, you guys have the opportunity. Some of you on this call today are already working, with us, and some aren't. You guys are more than welcome to come to the 2-day workshop in Orlando. We're confident that at the end of 2 days, we'll earn that contract from you. So the long way to answer your question is no, it's not a requirement. Drew, couple of questions are asking about the current cost of joining Horter.
Yeah, to register, there's a $595 fee. That includes your state registration fee. And our E&O, which is $14.95 a year. I think it's prorated now to August. That's our anniversary date. That covers life, annuity, disability, long-term care, and IAR coverage.
Very good. And I think that this will kind of probably come in the introductory email, Drew, but a couple of questions too are what materials are needed to study for the 65, and I think you guys help with that whole process, correct?
Yeah, you'll have a PDF that says how to become an IAR, and just go through. That'll take you through where to study, where to take the exam, where to set up your window, your 120-day window to take the exam. Once you pass the exam, what do you do? And contact our office. And then we start the registration process with a U4. That generally takes about 2 weeks, depending on your state. And then you're registered and good to go.
Perfect. And then the last one here, it just says, what fees to clients?
Yeah, we already covered that. That's the average fee, and then the escalation, depending on how successful you are, you can get upwards of up to 1.3%.
All right. Last one here, and then we'll wrap it up. Do you need to be affiliated with a broker-dealer when you have your 65? His question.
No. That's why I mentioned earlier. I was with 4 broker-dealers in my past, and I know I got absolutely 0 training from any type of broker-dealer. They would always say, here's 5,000 mutual funds, here's 30 variable annuities, here's 15 non-tradable REITs, here's 30 variable annuities, and this is how we mark up bonds and principal trade on stocks, go get successful. And that's how it works, and it doesn't work that way with us. So all you need to do is affiliate with us as a Series 65 RIA. Now, I will tell you, though, if somebody has large trailers in mutual funds from a broker-dealer, or they have trailers on VAs and they need a broker-dealer temporarily, we do have what we call friendly broker-dealers we work with that will take your business, and they love our training, they love our platform. But if you got to have that, keep that Series 6 or Series 7 for a while, we can talk about how to do that. But as a general rule, you don't need to have anything on the FINRA side as far as a license to work with us.
Great. All right. Thanks, Drew. It looks like that's about it. Again, everyone will get a follow-up from both John and I at Optima and Horter as well. Drew, I just want to thank you again just for taking the time today to get your platform out there to our agent. I think it was very informational. So, with that being said, John, is there anything you'd like to add, or ready to wrap it up? We might have lost John. So anyway, thanks again, everyone. Drew, thank you, and look forward to working with everybody real soon.
Yeah, thanks a lot, Greg, and thanks, John. We appreciate it, and look forward to talking with everybody.